Good morning, everyone. Today we're going to discuss the detailed study of banking frauds and some case studies related to it. Our group members include Trapti Jain, Shruti Agarwal, Rishita, Kapil Sharma, Adesh Srivastav, and Sudishnu Kulkarni. So, without further ado, let's get started.
One of the most important responsibilities that a bank has is to protect its integrity by working hard to preserve the financial assets which it holds. In order to do so, the banks or financial institution must be certain to address the issue of bank fraud. Bank fraud can be defined as an unethical or criminal act by an individual or organization to illegally attempt to possess or receive money from a bank or financial institution. Bank frauds can be of different types like accounting fraud, loan fraud, ATM fraud, money laundering fraud, etc.
Accounting fraud is the illegal alteration of a company's financial statements in order to manipulate a company's apparent health or to hide profits or losses. Money laundering is the process of changing large amounts of money obtained from crimes into originating from a legitimate source. Phishing is a fraudulent practice of sending emails or phone calls purporting to be from a reputable company in order to induce individuals to give out sensitive and personal information such as passwords and credit card numbers.
Effects of banking fraud. Banking scams are one of the most disastrous factors for any economy. Hence, the scamming banks must face stringent action by the regulators. Bank scams cause a disbalance in the economy, often leading to the weakening of the market. Due to such scams, stock markets face huge crashes, thereby affecting the economy in a big way. This causes a slowdown in economic growth, often leading to the weakening of economy and often disappearance of foreign investment. Banking frauds also cause foreign portfolio investors to look for other viable options to invest their money in place or economy that they see more trustful. Once banks start to fall, this leads to greater effect on the economy. The economic impact caused by the economy is wide ranging and it significantly affects the normal lives of people as well. Often this leads to a shift in the trust from the banks to other monetary means. Though banks and banking scams might not be new, but repercussions of a scam are widespread these days. Earlier, limited number of people, mostly the rich, had dealing with the banks, but in the past 1 or 2 decades, banking services have also been availed by even the poorest of poor in India. Thus, we can say that when a scam is discovered or when a bank collapses, the whole public sentiment goes down with it.
The king of good times. Yes, the Vijay Mallya, because of his extravagant life, has led Kingfisher Airlines into great trouble. There was a deed signed between SBI and Kingfisher Airlines on August 10, 2010, and SBI was given ownership of all trademarks and goodwill if Kingfisher Airlines failed to repay its debt. This includes Fly Kingfisher, Flying Models, Fly the Good Time, etc. As on January 31st, Kingfisher Airlines owes Rs 6,963 crores and all the banks had classified the loans as non-performing assets, which includes SBI, United Banks of India, and they have declared Mallya a willful defaulter. As per the notice, the borrower is Kingfisher Airlines and guarantors are United Breweries Limited and Vijay Mallya. UB Group Chairman Vijay Mallya, who's grounded Kingfisher Airlines Limited, has not returned 99,100 crores to a consortium of banks led by SBI and left for the UK on 2nd March.
Here are some of the reasons behind the financial crisis of Kingfisher Airlines, which eventually shows that the main reason behind his failure was that Vijay Mallya focused on expansion more than focusing on current state of the company, which eventually failed and led him and his companies into great losses. Now, let's move on and discuss about the shortcomings in the light of the Vijay Mallya case. It is mentioned that various loopholes have come into the picture in regards to Sarfazi Act 2002 while dealing by the banks with a major loan default case of Kingfisher Airlines and its chief Vijay Mallya. The Sarfazi Act, a 2002 law, empowers banks to attach assets of defaulters. In the Mallya case, the banks had moved the DRTs in 2012. There have been at least 20 cases pending and hundreds of hearings and adjournments at different DRTs, High Courts, and the Supreme Court. Fast track courts too are needed in India to take these cases to closure fast. The assets, especially the immovable properties being disputed themselves, do not attract buyers, which eventually decrease their value and keeps the bank hanging and they are not able to recover their money. Poor coordination among public sector banks is also the main reason for the rise in the non-performing assets, and it is necessary to direct them to join hands and mandatorily seize the assets of willful and hardcore defaulters. While asset reconstruction companies have come up, there's more supply of restructured assets than there are buyers. The ARCs also pay very little against the securitized receipt issued by them, and consequently there's no market for these receipts. It is both shocking and demanding that an individual has successfully managed to take some 17 banks for a ride. There are several other accounts where banks have been struggling for years to recover money and chances of recovery is almost nil. Banks acting as charity house for lending loans to Mallya calls people to question the credibility of authorities involved in credit appraisal process. The two major tools the regulators have introduced so far are willful defaulter tag and most recently the provision for strategic debt restructuring. But even if banks apply these provisions on loan defaulters, court's intervention prevents or delays any swift action by banks, diminishing lenders' ability to act.
My name is Adesh Srivastav and let's talk about the PNB Bank scam. The scam had taken place in the Brady House branch of PNB Mumbai. The fraud taken place by using the letter of undertaking LOU. LOU can be used in the export related transactions. The PNB scam was largely a result of unauthorized issuing of LOUs by the PNB Bank staff. The scam got exposed on 29 Jan 2018 when the PNB filed a police complaint against Mehul Choksi and others for the financial fraud of rupees 280 crores against the firms Diamond, Solar Export and Stellar Diamonds. On 14 Feb 2018, the PNB revealed that total fraud with the bank was of rupees 11,400 crores. Later, it came in the knowledge that not only the PNB but SBI, Union Bank and UCO Bank also had the exposure of 212, 300 and $400 million. Mehul Choksi has been booked under the various provisions of Prevention of Money Laundering Act, Indian Penal Code and Prevention of Corruption Act.
Now, the question arises how the scam taken place. First, let's see how the system should work. Nirav Modi and company, let's call them the N companies, goes to the PNB and tell them, hey, we want money to import jewelry from Hong Kong. A couple of 100 crores will be really cool. PNB issues a letter of undertaking LOU to the N company after doing the due diligence of business, repayment capacity, etc. This LOU is a form of guarantee to the lending bank. In our case, Allahabad Bank in Hong Kong. Allahabad Bank Hong Kong accept the LOU from N company. PNB employees in India issue swift instruction for payment to the Allahabad Bank Hong Kong. Allahabad Bank then deposit the money in PNB account. We call it nostro account in the Hong Kong branch of Allahabad Bank. Later, the said money is transferred to the N company's account. This amount is then used for paying the dealer in Hong Kong in the local currency. In this scenario, it was good deal for N company as they are saving on currency conversion and to add to it, foreign country banks offers lower interest rates. Overall, it is an honest win-win situation. Now let's look at the actual scenario and how the N company duped the banks. Now let's see how the system should actually worked. N company as per the scenario asked for LOU from PNB. but multiple LUs were issued to the end company without any due diligence, and no one in the organization except the issuing employee had a clue about this. Swift instructions for issuing the payment had no entry in the PNB's bank software system. Money was transferred to end company's account. Repeating above steps for the multiple LUs, money kept flowing into the end company's account. Now, let's talk about the pitfalls which led to this scam. There was no transparency. Although we live in the era of core banking, still at organizational level, PNB was not aware that one or a group of employees were taking the entire organization on a ride. There was no traceability and authenticity. Allahabad Bank accepted the LOU on the face value with a good faith. However, there was no traceability to prove authenticity of the letter.
Bank of Baroda Forex scam. India's second largest state-owned lender, Bank of Baroda was found at the center of rupees 6,000 crore foreign transaction scam. The Ashok Vihar branch of this bank in New Delhi was a relatively new one and had received permission to accept forex transactions only in 2013. Within a year, the forex business of this branch shot up to rupees 21,000 crore. The bank noticed these suspicious transactions and alerted the government agencies, who sprung into action with CBI and ED working on the case. The problem was that the accused traders had evaded custom duties and overclaimed duty drawbacks in order to generate slush funds. Now, let's have a look at the timeline of the scam. Between May 2014 and June 2015, the Ashok Vihar branch opened 59 current accounts through which large forex transactions were undertaken. Up to August, a total of 5,000 outward foreign remittances worth Rs 3,500 crore were made. It was not until July that the bank noticed these dubious transactions. In September, the bank's internal audit department began a detailed investigation and reported the matter to the government authorities. During October, raids in connection with alleged illegal remittance of around 6,000 crore to Hong Kong were carried out. On October 12, CBI arrested Bank of Baroda's Ashok Vihar branch head SK Garg and the foreign exchange head of the branch JNS Dubey for criminal conspiracy and cheating. Now let's have a look at the scam. During the scam, two different types of transactions took place. Both can be related. Number 1, exploiting government export schemes. In this case, dummy companies were opened in Hong Kong. The exporter, who had black money parked abroad, used these entities as clients who sent the money back to India to make the transaction look genuine. Government, on receiving forex, dispersed the duty drawback money to the exporter since the entire transaction was closed. These fake entities resell the goods at a market price and pad it up with their own money to overclaim the duty drawbacks. The second transaction involved advance remittances for imports. A whopping 6,000 crore black money was remitted from Bank of Baroda to Hong Kong, camouflaged as payments for imports like cashews, pulses and rice. The actual exports were made to Afghanistan, while the invoices were generated by Hong Kong importers. As per our banking system, a remittance of up to $1 lakh does not raise an alarm and is automatically cleared without supporting documents of imports. The money launderers exploited this loophole to pass under the radar. Rules not followed. The entire scam came to light because BOB officials pointed out the suspicious transactions to the investigating agencies. But there were lapses at BOB's end too. Banks are expected to raise Exceptional Transaction Report (ETR) and Suspicious Transaction Report (STR) with the RBI in case of discrepancies. Delay in pointing out these issues resulted in the scam gaining momentum. As a result, the Financial Intelligence Unit (FIU) charged Rs 9 crore penalty on BOB for failing to adhere to anti-money laundering norms and not having an effective system to report suspicious transactions.
We have heard about Nirav Modi, Mehul Choksi and Vijay Mallya. But on 7th of Feb this year, CBI reported an FRI against a company and its directors to execute the India's biggest bank fraud. Yes, we are talking about ABG Shipyard. ABG Shipyard is quoted to have defrauded the ICICI-led consortium of 28 banks to the tune of 22,800 crore rupees. ICICI has lent almost one-third of the total NPA account, and this makes it the most affected bank of all the 28 lenders. ABG was in losses post-2012, which was its last year as a profitable business. In 2013, it reported a loss of 200 crore rupees. In 2015, it reported a loss of 900 crore rupees. And in 2016, a loss of 3,700 crore rupees. The company had 16 shell companies. These are companies for namesake and do not have any operations on their own. and are mostly used for money laundering. It further used 98 sister concerns to route the loan amounts to either pay off other installments or to buy personal assets. As you can see in the following picture, how ICICI Bank led the 28 bank consortium in lending to ABG Shipyard, followed by IDBI and SBI Bank, according to the loan advanced amount. So here's how the ABG Shipyard scam panned out over the years. After non-payment of several installments of loan taken by the company, in August 2013, its account was declared as NPA by the lender banks. In March 2014, loan to the company was later approved for restructuring under corporate debt restructuring. Restructuring is the process of increasing the term of repayment and lowering of interest rate so as to increase the chances of repayment by the borrower. Post failure of the efforts for restructuring in 2016, the lender banks appointed EY to conduct a forensic audit of the company. This report was later submitted in 2019. On 25th April 2019, owing to the findings of the forensic audit report, which surfaced mismanagement of the loans taken, existence of shell companies, etc., ABG Shipyard Limited's account was declared as fraud by the lead banks. On 8th November 2019, a complaint with Central Bureau of Investigation was filed by the SBI on behalf of all consortium lenders. And finally, on 7th of Feb this year, CBI registered an FIR against ABG Shipyard and its directors.
Did you know that in the year 2021, in response to a right to information query, RBI revealed that India witnesses 229 banking frauds on an average every day, and the recovery rate of all of them combined is less than 1%.
As future bankers, what we should really ask and discuss among ourselves are the following questions. Should any bank be allowed to lend huge amounts to a single entity? In case of ABG Shipyard, as much as 7,000 crores. Why it took almost a decade to book the company and its directors for having defrauded banks of over 22,000 crore. What is due diligence for these banks? Are they following it? Is the banking industry learning from its mistakes? If yes, then how the fraud amounts over the years is consistently on an increasing trend. What is to be seen is how rights empowered to the banks in the SARFAESI Act are used to recover at least a percentage of the total loan amount.